In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, U.S. lawmakers blast T-Mobile's proposed $26.5 billion purchase of Sprint as leaders from both companies testify before the new Democratic-led House. Plus, the Saudi Wealth Fund is putting a stake in the ground in Silicon Valley, opening a San Francisco office. But will the tech industry welcome the kingdom? And as T-Mobile's John Legere slams Huawei, the Japanese billionaire CEO of Rakuten tells me he won't be using Huawei or ZTE either as he builds a new mobile network in Japan. But first to our top story, Sprint and T-Mobile execs in the hot seat in Washington as lawmakers grilled them over their proposed $26.5 billion merger. T-Mobile CEO John Legere and Sprint Executive Chair Marcelo Claure appeared before the House Communications Subcommittee defending the mega deal against claims that it is a threat to competition.
Our opponents are wrong when they claim that the merger will lead to higher prices. In fact, the opposite is true. Consumers will win with lower prices and better services. How? Our costs will drop sharply and our network capacity will expand tremendously.
9 Democratic senators, meantime, called for the deal to be stopped in a letter Tuesday saying that it would hurt consumers. Joining us from Washington to discuss, we've got Georgetown Law Institute Distinguished Fellow Gigi Sohn and Bloomberg's Todd Shields, who covers the FCC. So, Todd, what exactly was Legere's message today?
His message was pretty simple, and it's the one we've been hearing for a while, that the merger is good for competition because it will wrap in 5G and such great advancements that'll make the company a stronger competitor to AT&T and Verizon. But it seemed like not everybody was buying it. He fielded a lot of questions from Democrats worried about coverage in rural areas, worried about possible price hikes hiding somewhere within his pledges not to do that.
Gigi, talk to us a little bit more about what lawmakers' biggest concerns are.
Sure. Well, first of all, I think it's important that the concerns at this hearing today were not just from Democrats, they were bipartisan. And as Todd said, there's concerns that when you combine 4 mobile wireless carriers into 3, prices will go up because you're eliminating a competitor. And particularly, there was concern about low-income consumers, because one of the things that have gotten lost in these merger discussions is the fact that if you combine T-Mobile and Sprint, you're combining 3 of the biggest prepaid carriers. So that's Virgin Mobile, Boost Mobile, and Metro PCS. So this will have a disproportionately harsh impact on low-income consumers. And what's fascinating is that in filings at the Federal Communications Commission, Sprint and T-Mobile's economists have said, yeah, we know that this is going to raise prices on low-income consumers, but they use their cell phones a lot, so they'll just bear the cost, which I think is a remarkable admission.
Now, let's take a listen to some of the pushback. Here's a clip from Congressman Mike Doyle. Listen in.
That would take the prepaid market from where it is right now at $24.67, which is just under DOJ's threshold, to $44.81, a level that raises lots of red flags. These kinds of numbers have historically resulted in higher prices for consumers, less competition, and less innovation.
Now, that said, Todd, didn't John Legere in this hearing promise that prices wouldn't go up?
He said it a couple different ways, but after the hearing, I talked to Doyle, and Doyle's not convinced. And Doyle wants the regulators, the Federal Communications Commission and the Justice Department, to take a quick look. There's lots of, or take, a deep look at it. There's a lot of different ways to make pledges about prices and a lot of ways to adjust the prices after and say, oh, gee, look, you've got a lower price considering what you've got. And it's just not trusted right now by some in Washington.
Gigi, is this a promise that if this happens, that Legere would actually be held to?
So this is interesting. So T-Mobile has made a 3-year pricing commitment, promising not to change the prices of rate plans. Now, there are so many loopholes in that you could just drive a truck through it, right? They could change their data caps. They could, increase their network quality and increase charges there. They could increase third-party charges. So that quote-unquote pricing commitment is no commitment at all. But there's a more important point. Particularly in this administration, you know, policymakers have already said, the Assistant Attorney General, Makan Delrahim, has already said, we do not want to be overseeing merger commitments. We do not want to be acting as a regulator and looking at whether companies are abiding by their behavioral commitments. So there's no appetite for behavioral merger conditions, and frankly, they don't work. They didn't work in the Comcast-NBCU merger. In fact, Bloomberg was one of the unfortunate non-beneficiaries of that. They don't work in other mergers, and particularly in this administration, nobody wants to be in the business, neither the FCC nor the Justice Department, of essentially engaging in price regulation.
Now, you know, Ledger had quite a few pronouncements at this hearing. Take a listen to this one about Huawei.
Let me be clear. There is no Huawei or ZTE equipment in our network today, and there never will be. Not today, not tomorrow, not ever.
Of course, T-Mobile has been involved in a case involving Huawei and allegations that they stole intellectual property from T-Mobile having to do with robotic technology. Todd, what do you make of that pronouncement there from Ledger?
I think it's one that he could easily make. As he even said that we have a history with that company, indicating a bit of distaste with Huawei given their legal entanglements. There was a recent indictment of Huawei by U.S. officials alleging that Huawei stole T-Mobile trade secrets. But one thing you can say is that there's the pledge for T-Mobile itself in the United States. Deal opponents look to the parent corporation, SoftBank in Japan and Deutsche Telekom in Germany, and say, gee, look, there is Huawei gear there. So the influence is arm's length, and maybe that's not far enough, say critics.
Last quick question, Gigi. Can Sprint survive without this deal?
Absolutely. The notion that Sprint is a failing firm is nonsense. They're not even an ailing firm. They just put out their third quarter financials just 2 weeks ago, and they are gaining subscribers in the lucrative postpaid market. Their revenues are increasing across the board in both prepaid and postpaid. They've invested over $1.4 billion in their new networks. And there's nothing about their financials, frankly, for the last several quarters that make anybody think, or should make anybody think, that Sprint is anywhere near failing. And in fact, they're really on the uprise. So there's no need to have this merger. The promises that these companies are making, they're not merger specific. They haven't proven that they'd actually come to be. And the harms to consumers far outweigh the alleged benefits of this deal.
All right, strong opinion there. Gigi Sohn, always good to have you with us from Georgetown Law and Bloomberg's Todd Shields. Later in this hour, we will have new comments from Hiroshi Mikitani, the CEO of Rakuten, one of the biggest conglomerates in Japan, who says he is not using Huawei in his new mobile network. I just sat down with him, and we'll bring you that interview later in the show. Meantime, a story we are watching: Google will invest more than $13 billion in data centers and offices across the United States this year. CEO Sundar Pichai made the announcement in a blog post. The company is planning major expansions in 14 states, including Nebraska, Nevada, Ohio, and Texas. Pichai says the investment will create thousands of new construction jobs outside its traditional base in California. Coming up, thanks to new software and services, Cisco's second quarter results was a standout. We will break down all the numbers next. This is Bloomberg. Cisco out with an upbeat fiscal second quarter report. The tech giant giving a strong forecast for the current quarter, signaling its confidence that corporations are continuing to spend on their computer networks. For all the details, I want to bring in Woo Jin Ho of Bloomberg Intelligence. He follows the company for So, Woo Jin, this is a company that is often considered a bellwether for the global economy. What signals are we seeing here?
Sure. So in terms of the positive signals, is not only the growth that they delivered in the second quarter results, but also the forecast for the third quarter results. So if we're talking about 4 to 6% growth, based off, if you think about it, off a murky global macroeconomy, it's very strong.
So give us the highlights.
So quickly on the highlights, if you think about the Cisco story, the transition has been going from more hardware to software. And then what's driving the enthusiasm in the name or the story today is the application growth of 24% on a year-on-year basis, security software growth of 18% on a year-on-year basis. Those are the two metrics that investors have been focused on in terms of the long-term direction. And then the guidance actually reinforces that that direction is going to continue, at least in the near term.
So how does this jive with some of the other indicators we're seeing? A massive slowdown in China, for example, general political and economic uncertainty.
Sure, and that's a fantastic question, Emily. I mean, if we look at the tech earnings season this past quarter, Intel was talking about China being slow in terms of the data center cloud server business. We're hearing data center investment slowing down because we've seen a lot of cloud companies consuming some of the excess inventory. Now, there's a couple of things about Cisco that I think investors, that's nuanced to Cisco. Number one, they have very little China exposure. I think it's less than 5% of revenues are exposed to China. And number two, if you think about it from where the big driver has been, it's been more on the campus and the enterprise switching business as well as software. That's less exposed to some of the data center cloud investments that have been slowing down. So I think that's one of the reasons why Cisco has been able to exceed expectations into results.
Now, Cisco CEO Chuck Robbins has been out there ringing the privacy alarm bells along with Apple CEO Tim Cook. Is this part of a strategy?
I think it's part of a broader strategy of the tech bellwethers. I think companies like Apple as well as Cisco are trying to be the parents in the room and try to differentiate themselves from the other hyperscale guys who do use data as part of the business model. Cisco, given that they are the heart of the network and a lot of data traverses through some piece of Cisco equipment anywhere in the world, I do believe that they want to ease investor expectations and also user expectations in terms of data privacy.
Certainly seems as if a line has been drawn in the sand in big tech. Woo Jin Ho of Bloomberg Intelligence, thank you for weighing in. Now, this is a juicy one. A former top lawyer at Apple, Jean Daniel Lavoff, was responsible for making sure employees didn't violate insider trading laws. But he was the one allegedly buying and selling shares illegally, at least according to U.S. authorities. Joining us now, Bloomberg's Mark Gurman, who's been covering the story for us. So, Mark, what exactly happened here?
Yeah, this is a bombshell. So last year, the SEC, the Securities and Exchange Commission, notified Apple that Jean Lavoff, who was one of their most senior executives in the entire company, senior lawyers, had conducted some insider trading based on having pre-access to press releases and earnings results related to their quarterly earnings reports. And he initiated some insider trading in 2011, and then it picked up again in 2015 and 2016. And Apple seems to have confirmed that this indeed happened because they said they launched their own investigation last year and then ended up terminating or firing Jean Lavoff. So clearly a bombshell, clearly a black eye for Apple, which has mostly, to be fair, had a clean record in this regard since Steve Jobs was accused of options backdating back around 2004, 2005.
Apple, in a statement, told us, after being contacted by authorities last summer, we conducted a thorough investigation with the help of outside legal experts, which resulted in termination. So sounds like they took swift action.
Right, yeah, they clearly took this seriously, and no matter how high level an executive is at Apple, they clearly don't get a pass here. We saw this back with the options backdating scandal. Apple's former CFO, this was 2 or 3 CFOs ago, Fred Anderson, he had to leave Apple's board of directors at the conclusion of that investigation. Jean Lavoff, extraordinarily well-regarded Apple executive, very high up. He's listed on lots of Apple, older Apple SEC filings, obviously. He's listed as the director of many of the corporations and entities that Apple has acquired over the last, couple of decades. Very high level, and he was terminated at the end of this investigation.
Just some of the numbers. This led to $227,000 in additional profit, but allowed him to avoid $377,000 in losses. Is there a void in Apple's legal department with him leaving, or, is there a pretty strong bench?
Apple actually revamped part of its legal department at the end of 2017 when its former general counsel, Bruce Sewell, retired from working at a technology company, leaving Apple. Kate Adams, she came from Honeywell as the new general counsel, and she shuffled some of the top people there. So yeah, there is a deep bench in the legal department, but something really important to note here. So he avoided losses of about $350,000. He profited around $225,000 or so, as you said. But the Apple employee salary for someone in that level is probably close to $1 million base salary, and a few more $5 to $10 million in additional stock options on an annual basis. So forfeiting all that and the career over $300,000 or so seems like a poor choice on his part, and it's good to see Apple taking swift action.
All right, Bloomberg Tech's Mark Gurman, thank you so much for filling us in on that one. Coming up, Akamai's fourth quarter numbers are out. CEO and co-founder Tom Leighton tells us what to expect for the rest of 2019. They have a very unique view of what's going on across the internet. And Bloomberg Tech live streaming on Twitter. Check us out at Technology. Follow our global breaking news network TikTok on Twitter. This is Bloomberg. NASA's Opportunity, the Mars rover, was supposed to last just 3 months. But today, after 15 years, its mission was finally declared complete. Flight controllers tried numerous times to make contact with the vehicle and sent one final series of recovery commands, along with one last wake-up song, Billie Holiday's I'll Be Seeing You. There was no response from space. Had a good run, though. While Akamai reported stronger than expected fourth quarter results Tuesday, beating estimates for both earnings and revenue. This as the company's cloud security business grew 39% over the quarter. Akamai also announced a joint venture with MUFG, the largest bank in Japan, to offer a new blockchain-based online payment network. Joining us to discuss, Akamai CEO and co-founder Tom Leighton. So Tom, tell us about this new payments network.
Well, it's pretty exciting. The goal is to replace the legacy transaction system for banking with a blockchain-based system that will be much faster, more scalable, more efficient, and of course, secure.
So you, of course, have a very unique view of what's happening across the web. We were speaking about Cisco's earnings results earlier, which were very positive amidst all these economic headwinds, an economic slowdown in China, general political and economic uncertainty. Are you seeing any of that reflected across spending?
In our business, we're doing very well and looking forward to a strong year ahead. Cybersecurity is not something that is negatively impacted by those trends. Every enterprise needs security solutions more than ever. And that's a good reason, why our security business is growing so rapidly. So as we look ahead to 2019, we're seeing a strong year for growth. And with our earnings per share, we forecasted at the midpoint of the range at 14% year over year in 2019.
How big is the addressable market for your security products?
Oh, I think it's very large. Today we focus on the denial of service prevention and stopping application layer attacks for consumer-facing websites. There's a much bigger market of protecting enterprises with their employees and their applications and their data from, for example, data breaches. And we've developed a new zero trust enterprise security architecture that we're bringing to market. And we think the potential market for that is even bigger than what we're already doing with denial of service prevention and application layer protection.
Does Akamai have any business in China? And if so, will it be impacted by the trade issues?
We do have business in China, both from non-Chinese companies delivering content into China, and also for Chinese companies that want to deliver content outside of China. And that business has been growing rapidly. So far there hasn't been a major impact, with some of the challenges in the region. And we have excellent relationships with major Chinese companies and carriers. So I think we're in a good position there.
There seems to be growing tension between consumers who want to trust their tech companies and the products that they use and the business models of these tech companies trying to squeeze as much value out of the data as possible. Do you think there's a fundamental disconnect emerging?
Well, this is certainly a challenging area. And it's an area that we're working on from the perspective of keeping user data private and making sure that it's only used in the ways that users want it to be used, and respecting the laws that are being put into effect in several countries around the world. The general data privacy regulations. So we actually help our customers respect those regulations by making sure the data stays where it's supposed to and is only used in ways that it's supposed to be used.
Do you think GDPR is working?
I think it's very early days, and it's a very complicated set of regulations. And I think it reflects the inherent tension between having your data used in good ways, but not in ways that you can't control that aren't so good. And it's hard to legislate that.
All right. Tom Layton, CEO of Akamai, always good to have you with us. Thanks so much, Tom, for stopping by.
Thank you.
Coming up, Tesla rushes to get Model 3s to China before the trade war truce expires. How Elon Musk risks getting hit from both sides as tensions flare up. And coming up later in the show, tech giants from SoftBank to Facebook and Amazon have done business with Saudi Arabia in the past. Now the kingdom wants to rent some space in Silicon Valley. But times may have changed. This is Bloomberg. This is Bloomberg Technology Global Link, where we join Bloomberg Daybreak Australia to bring you the latest in global tech news. I'm Emily Chang in San Francisco with Sherry Ahn in New York and Heidi Stroud-Watts in Sydney. Let's take a look at the global tech stories of the day. Heidi, what do you got?
Emily, Apple is planning to unveil video and news subscription offerings next month. This is the first major new digital services from the company since 2015. The video service will be similar to Amazon's Prime Video and Netflix products. That'll include TV shows and movies either acquired or funded by Apple. According to people familiar with the matter, the paid service will launch by the summer. A new question surrounding Uber's license to operate in the City of London. The city's taxi drivers, represented by United Cabbies Group today, brought a legal challenge against a June ruling that granted Uber with a 15-month probationary license to operate in the UK capital. London's Transit Authority had previously revoked the ride-hailing giant's earlier permit over safety concerns. Initial coin offerings are plentiful despite a rocky past year for cryptocurrencies. About 70% are holding token sales, 70% of companies, I should say, and another 17 are planning ICOs as of last week. The market is at a fraction of what it was back in 2018, but still it is bigger than at the start of 2017. This difference is that most ICOs are now launching overseas instead of in the US, and they're targeting wealthier investors. Those are your top global tech stories of the day that we're watching. Emily.
Heidi, thanks so much. Well, the e-commerce giant Rakuten is one of Japan's biggest conglomerates and in the geographical crosshairs of the U.S.-China trade war. Earlier, I spoke with Rakuten CEO Hiroshi Mikitani to talk about a range of issues, including how the trade tensions are impacting his business. He gave me an unexpected answer and talked about why Rakuten has chosen not to go with Huawei or ZTE as it is ambitiously building a new mobile network in Japan.
When we are deciding what kind of network equipment we are going to use, I talked with the Japanese government and asked about whether I should use Chinese network equipment or not, and they said no problem, use it. But I kind of sensed the potential risk, even if it's like 1%. I told myself I cannot take 1% risk that something may happen to prohibit Chinese network equipment to be used for the Japanese mobile network. So I decided not to use Huawei or ZTE.
Because of the risks of espionage?
Because of the risk. So I don't know whether it's true or not, but I'm very, very happy I didn't choose them right now, because if I had chosen them, that means I need to roll back like 1 year, and I cannot launch my service.
Who'd you choose?
We choose Nokia, but basically we are building our own hardware. We just buy the antenna hardware from Nokia, but maybe in the next generation we're going to build our own. So it's totally different concept. We are an IT company integrating, building core network, radio station network, all the technology by ourselves, versus other telcos are asking system integrators to integrate everything.
So do you think then that Huawei's business, ZTE's business, I mean, do you think those could be seriously compromised as a result of?
That's for sure. Yeah, it's obvious, no?
Yeah, I mean, I guess they're still huge companies. They still have the Chinese market.
It's a good company. But I think, I don't know what is going to happen, to be very honest. But as far as the telecom industry is concerned, that, it is very difficult to use Chinese vendors for a while.
Fascinating revelation there, and something, Sherry, that we didn't know. This is a company that's a big e-commerce conglomerate, but has these plans to build Japan's 4th wireless network. Somewhat controversial plans, because he says he can do it with just $5.5 billion. But unprompted, he said he's not using Huawei or ZTE equipment in that network because of concerns about espionage. However, the Japanese government didn't seem to share those concerns. Certainly very, very interesting, given all of the controversy around Huawei right now, around what we saw from T-Mobile CEO John Legere testifying before Congress earlier today, him saying that Huawei equipment will never be in T-Mobile's network. Not looking good for Huawei.
Yeah, very interesting. Many governments, maybe not the Japanese, but other governments like New Zealand, really shunning Huawei as well. But I gotta be honest, Emily, I used to shop in Rakuten when I was back in Japan. I love their products, so I'm a big fan. So now they're trying to, as you say, trying to take on SoftBank in the e-commerce space, trying to take on Amazon. What exactly did the CEO say on that?
Well, it's interesting because Rakuten has been somewhat struggling in terms of taking on Amazon in Japan. Of course, they have first mover advantage, but if you look at the granular data, in some ways Amazon in Japan is actually beating out Rakuten. So this decision to build a new mobile network is in part of the strategy to globalize beyond, simply an e-commerce giant. So I actually asked him who's a bigger threat, Jeff Bezos or Masayoshi Son, and he said, well, kind of both. They're both competitors. But interestingly, he was actually friends with Masa Son back in the day. He was one of his first clients when he was an investment banker before he even started the company. So this is actually all part of a longer conversation that you're going to see on an upcoming edition of Studio 1.0. We talked all about his ambitions, taking on not just Amazon, but SoftBank and the wireless industry in general, and it's a fascinating conversation.
Yeah, the battle of the billionaires, right?
The battle of the billionaires. Always a fun, juicy one to talk about. Thank you so much, Sherry. We have much more ahead, so stick with us. This is Bloomberg. Saudi Arabia is looking for office space in San Francisco, specifically for its public investment fund. This follows similar moves from regional neighbors Qatar and Abu Dhabi. The Saudi fund has made several large investments in tech recently, including high-profile bets on Uber and Tesla. And this move comes just months after Saudi Arabia faced international condemnation for the killing of the journalist Jamal Khashoggi at its Istanbul consulate. Joining me now to discuss, Nuala O'Connor, the CEO of the Center for Democracy in Technology. So, Nuala, what's your take on the unabashed expansion of the Saudi investment fund into Silicon Valley?
Well, it's obviously a hot market, and there's lots of foreign investment in Silicon Valley and across the United States tech sector. The concern really is one of values and whose values are driving the creation of new products, services, and apps. We've seen just recently some outcry over the creation or the support of an app led by the Saudi government that allows people to track female associates or relatives. These are concerning kinds of applications, and we would obviously want to espouse democratic values and values of equality and liberty. That's part of my organization's name, is Democracy and Technology. So the question for me is one of what kind of values are we embedding in the technology in our daily lives?
Do you think these companies, which have certainly done business with the Saudi in the past, will change their tune?
Well, this has been an age-old debate since there's been a tech sector in the United States as they've expanded and done business in other countries. And it is also a conflict, a little bit of laws and of cultures. The international internet allows for the export of U.S.-centric values by U.S. companies and vice versa from other countries and other values and other companies. So we're at the conversational point about Saudi Arabia that we've been at about China and other countries and how they run their internal operations and how they use technology.
So where do you think this goes? There has been a lot of private talk whispering about whether companies should or shouldn't take SoftBank's money because so much of SoftBank's Vision Fund money comes from the Saudi government. Do you think this issue dies, or does it continue to be an issue? Because I certainly have yet to hear someone say, we didn't take that $500 million because it came from SoftBank.
I think it's very difficult when there's that kind of money on the table to make those kind of choices, I'm sure, for the corporate leadership. But I do think the conversation is absolutely going to continue about the values and the norms and the democratic principles embedded in the products and services that companies are creating, and the sources not only of funds, but of revenue from the sales of those products. And I see those calls coming as much from within Silicon Valley and the employees of many of these companies as I do from outside, from civil society and groups like mine. So I think this is a conversation that we're just beginning in many parts of this country and really around the world. This is not the last we'll see of it.
Meantime, I want to talk to you about trust of the tech industry more broadly. There's a recent poll out conducted by YouGov, which shows that Facebook is one of the country's least trusted institution, right down at the bottom by Congress, whereas Google and Amazon are towards the top. And yet Facebook just reported earnings, and it keeps growing. It doesn't seem to be losing users. People are still using it. How do you square that?
Well, it's a terrific platform in many ways, and it's useful and it's free. I do think that we are having a conversation about the use of information and the use of personal information by companies of all kinds, not just in the tech sector. So I think that may account for some of the difference in the various brands' trust factors. But I think we are in a position now as a country to have a conversation about the use of personal information by all companies and the respect and the dignity that companies allow their customers, their employees, their partners. I think we're going to see comprehensive privacy law in the United States in the near term to put us back on the global playing field about privacy and data.
How much do you think consumers actually want comprehensive privacy regulation?
I think that the pendulum has swung very far in the direction that more and more average users, citizens of this country, realize that they're not necessarily getting a fair deal as people in other parts of the world are getting, even from some of our own companies, in the protection and use of data and the disclosure of how those data are being used by the company. I think that there is a very practical reality. People want to use these services and they want to be part of the internet economy, but they want to know a little bit more and have a little bit more balance of power between the individual and the companies themselves.
So then is that trend on a collision course with the business model of these companies that make money based on how much data we share with them and how much they can squeeze more value out of it?
I think data is very much a source of power for many internet companies, and I think there will be real changes and kind of a real come to the table meeting of all of the companies and how they're using data and how the various business models work. I think hopefully we're going to see a race to the top in the conversation, which has been begun by a number of CEOs, not only in Silicon Valley, but across the United States, in what their commitments are to the use of data about their customers.
Can the U.S. catch up to Europe at this point?
I'm not sure we want to only catch up to Europe, meaning that may not be the perfect model for the United States. They have a very different kind of enforcement mechanism and model than we do. But I think that there are global principles about dignity, about transparency, about accountability, about how these companies explain what they do and get consumer buy-in and not just consent, but really do the right thing. Because I think the notice and choice model that we've all relied on with lots of privacy policies is really a thing of the past. As technology becomes embedded in the walls of our houses and the dashboards of our car, we want to know that we're being treated fairly and that there are certain uses that are in bounds and there are certain uses that are simply out. So I think we can do this, and it'll look up like a slightly different American model, but the principles will be the same.
All right, Nuala O'Connor at the Center for Democracy and Technology. Thanks so much for joining us back here. Nuala, always good to have you. Well, 2019 saw news outlets like BuzzFeed and the Huffington Post cutting staff. And it didn't end with them. What is next for journalism and journalists in the digital age? This is Bloomberg. The start to 2019 has been sobering for the journalism industry. Major publishers like BuzzFeed, Vice, Gannett, and more laid off thousands of employees. Sadly, this is becoming something of the norm for journalism since the advent of the internet. According to a 2018 Pew study, at least 36% of newspapers have experienced layoffs between January 2017 and April of that year. That number is 23% for digitally native outlets. Joining us to discuss, Tim Cadigan, CEO of OpenX. The company maintains one of the world's largest digital ad exchanges with over 34,000 advertisers and has recently announced a new partnership with Google that'll make it a full-time cloud-based service. Tim, great to have you back here on the show. So, many of these outlets launched with much fanfare, BuzzFeed, Vice, and grew quickly, and then now they're scaling back. What's happening?
Well, I think, the underlying question is the business model, right? And the business model is one of advertising. And advertising is kind of tale of two cities today. So overall advertising is doing extremely well. Advertising 2018 grew about 7%, twice the rate of the economy. Digital advertising grew 15%. Facebook grew 30%. So what's interesting about that is there is a lot of money being made in advertising, but there's an asymmetry here, which is a lot of people's time is spent on sites and apps outside of the major walled gardens like Google and Facebook. But the ad dollars are not matching that today.
Why?
So what's going on is that when you advertise on Facebook, let's take them for example, you reach a huge audience, you reach it with a lot of data, so it's scaled, it's efficient, it's effective, and it's actually pretty easy. So it works very well, so ad dollars are shifting over there. But marketers want to be able to spend in more than two places. And so the rest of the open web, which is many of the businesses you're talking about, they're part of what I would call the open web. They need an advertising model that works more like what works on Facebook and Google.
So what's it going to take to redistribute? Because I certainly don't spend half my time on, or all my time on Google and Facebook.
Correct, exactly. So there you go. So that's the problem. And so I would call it people-based marketing. And so what we need is a system that operates like people-based marketing on a walled garden for the open web, so that the ad dollars can follow the users and the attention that is being generated by all of those great outlets that are doing great journalism.
How do we do that?
So, you lean a little bit on companies like mine and peers in the space to frankly innovate more, and that's a little bit, the background of our Google Cloud deal, to innovate more and to get closer and provide a more viable complement to those really big systems.
Isn't that bad for Google, your new partner?
So Google is a multifaceted player, right? So for us alone, they are a big partner, they are a big customer, they're one of the biggest buyers.
And they're a competitor.
They're a competitor, and now they're a technology vendor. And so we embrace all those aspects, and that's sort of the way the world works.
Do you think that Google and Facebook's business models are under threat?
No.
By relying so much on consumer data?
No, I don't. I think that they have a very strong position because they create incredible consumer products, and they have a great trade-off between consumers and advertising for those products.
What about Amazon?
Amazon,
which
I think,
is growing in the ad business.
Increasingly, I've used the word triopoly because it's really the three players, not just the two players. And Amazon is building a very large advertising business very quickly. It has a number of great assets. It has amazing consumer data. It understands, of course, what people buy. Then it has millions of merchants who want to reach those consumers.
At any point, do you expect the ad business to feel the backlash around privacy, around consumer concerns about their data?
I would say it already has, right? I think the reality that we have to, anyone who's a practitioner of advertising today has to understand we have to move to a fully permission-based marketing system. And what I mean by that is consumers need to understand what's going on, they need to participate, they need to be out of control, they need to be able to embrace the system. Because the system is...
How do we do that?
Well, actually, regulation, the right kind of regulations are going to be a good thing. What we worry about, and I think our peers worry about, is in the US, 50 different sets of laws. That would be a big problem. If we could have one standard set of laws, and ideally as global as possible, that enable permission-based marketing, that's a good thing. That's where we need to get to.
All right.
To build the trust.
Fascinating. Tim Cadigan, OpenX CEO. Great to have you back here.
Thank you very much.
On the show.
Appreciate it.
All right. Tesla is rushing as many Model 3s to China as it can before the trade war truce with the U.S. expires on March 1st. CEO Elon Musk fears the two countries could ratchet tariffs back up. That would make the electric cars more expensive in China and raise the cost of components China sends to Tesla's U.S. assembly plant. Joining us now, Bloomberg Business Week's Max Chafkin. So, Max, is the rush warranted?
I mean, the rush is warranted in the sense that, number one, the trade situation between the U.S. and China is very volatile, and two, that Tesla is operating, on sort of very narrow band to be successful. As we've been talking about for, basically a year, they're under this production crunch. They're also just scrambling to generate as much revenue and profit as possible, and so, being able to, get these cars into China before a potential, 25% possible tariff hike, is going to be good for them. It also shows just how dependent Tesla is on China. I mean, we saw, a few weeks back, Elon Musk going to China, unveiling this, money field that is going to be the site of a factory. This is a company that really needs, to do a lot of business in China for it to have, the future that its CEO wants it to have.
I have a chart here in my Bloomberg taking a look actually at Tesla's revenue in China over the last several quarters. We're missing the most recent quarter, but Tesla's revenue per quarter in China, about 6% of global revenue. Do you expect that to significantly increase with this China plant?
Yeah, definitely. And Tesla needs it to increase because the demand for electric cars right now in the world, China is the biggest market by a lot. Now, some of that has to do with subsidies that the Chinese government is giving to buyers and the fact that there are these really low-cost electric cars in China. But if you want to look at like a market that is really embracing this technology like nobody else, that's China. And also, obviously this is a huge market. If Tesla wants to be, a leading global manufacturer, it needs to have its Chinese sales sort of grow commensurate with the size of the market.
So what tariffs or types of tariffs might Tesla face once this truce wears off?
We don't know, and part of the reason we don't know is because it would be sort of it would be like a tit-for-tat situation where the Chinese government would be responding to the Trump administration. So you could imagine just sort of an automobile tariff. I believe that's what was talked about last year. There's also this sort of cutout that the Chinese government made for electric car manufacturers in the country, where before manufacturers had to have a local partner. Now the Chinese government is saying it's okay for Tesla to open a factory on its own. Now, you could imagine if this trade war intensifies, that could change as well, and that would have huge implications for Tesla.
All right, well, the Model 3 is coming in droves to China's shores. Bloomberg Business Week's Max Chafkin, thank you so much for that update. And that does it for this edition of Bloomberg Technology. On Thursday's show, we're going to be speaking with Xander Lurie, CEO of SurveyMonkey, on the heels of their earnings results. And of course, we're live streaming on Twitter. You can check us out at Technology and follow our global breaking news network, TikTok, on Twitter. This is Bloomberg.